All right. So again, what we're going to do is we're going to build out a reusable Excel valuation model over the next several classes, starting with today. Today, what we're going to do is we're going to build out an 11-year forecast of the financial statements, and we're going to use Coca-Cola as an example using this Excel-based model. And then next week, we're going to add the valuation components. So you're going to basically be following along and building the model with me. The nice thing is when we're done with this process, you will have a reusable model that you will be reusing to build the financial statement model for your groups, as well as for individual assignments we're going to be doing over the next several weeks. So I'll just let you know that the pace of the class is about to pick up dramatically, and you're going to be doing a lot more kind of case study based assignments over the next several weeks, right? Including the next week in the Bloomberg Labs type stuff. So just giving you a heads up on that one. So what you want to do is you want to have this Excel file ready to go. We'll talk about that in just a minute. In the interim, just a couple words about the midterm exam. Part one of the midterm exam from last week, the average score, the mean, was 6.7 out of 7.5. So overall, everybody that took it did generally very well on part one. Part two is not graded yet. The TAs are still working on finishing the grades. And so hopefully once that's graded, we'll talk about that next week. But in the interim, part one solution is here in the files section. So if you want to see the Excel-based solution, it is there. And if you have any questions about that, you can either talk to myself or the TAs. All right. Second thing I want to mention is that starting next week, we are going to pick, and I'll assign the industry that you are in, and you'll pick one of the companies in that industry for your group projects. So the group projects will start and begin next week, right? And then the final two industries have been lined up. So we're going to have CSX, which, by the way, did anybody see CSX was in the news last week? What were they in the news for? Actually, I think it's more the other way around, but yeah. But basically, there's a potential merger between CSX and one of the Canadian rails. And why is that potentially happening? What's that all about? It's all about crude oil, right? Which the CSX person talked about in his presentation. But one of the key facts is that this year there's 120,000 train loads or train cars worth of crude being shipped. Next year it's going to be 200,000 train cars of crude being shipped, basically from that Bakken region way up there. And the problem is that because the Obama administration has been blocking any building of pipelines, then rail has become the only practical means of shipping it, and it's starting to explode on rail. So basically, what the Canadian Pacific Railroad, which goes from Alaska to basically Chicago, wants to hook up with CSX, which goes from Chicago to Philadelphia. So they can get a straight line to Philadelphia where there's a bunch of refineries with a bunch of excess capacity. So essentially, they want to optimize that route. That's what this merger is really all about. It's about all the fracking crude and moving it to the East Coast refineries as efficiently and cost effectively as possible. So that's what this tie-up is potentially about. So for the industry that's going to be doing rail, it's going to be some real interesting analysis. Another industry that I've just confirmed is going to be Novelis, which is the largest maker of aluminum in the world. They're about an $11 billion company. They actually make cans, recycled cans and aluminum cans. So if you drink a Pepsi or a Coke can, it's a Novelis aluminum product. They also make the aluminum for automobiles. So the Ford F-150, all aluminum F-150, that's their aluminum. So they're a very innovative company. They're actually owned by an Indian company called Hindalco. They're based in Atlanta, and I confirmed with their CFO that he's going to be participating with us. Lockheed Martin being the third company, and then there is a construction engineering company, which is the fourth company. So, as I said, next week we will push out the groups, and you'll be starting to work on the group project. So just alert on that one. And the other thing before we get started that I thought was interesting, because we're going to use Bloomberg here in a second, is did you see the headlines about GT Advanced and the insiders that were selling in advance of the Apple decision? Everybody see that? Everybody know who GT Advanced is? Okay, well, in case you're curious, there's a company called GT Advanced, which makes Sapphire, and was Apple's supplier of sapphire for, initially it's supposed to be for the iPhone. So you can make iPhone displays in sapphire. And they were also making the little fingerprint reader has sapphire in as well as the camera. But they basically invested in the sapphire company to ramp up production. It's a company called GT Advanced. And Apple had given them pretty much now in bankruptcy what looks like a $500 million filing or $500 million loan before the bankruptcy filing to basically ramp up and help them invest in their sapphire production. Well, they were having production problems with scaling up the sapphire, and Apple was not able to use the sapphire in their phones as was expected. So, conspiracy theory, this wasn't in the actual paper, but I'm holding here an iPhone 6 Plus that I was able to snag. These are the hardest iPhones to get. There's the iPhone 6 and the 6 Plus. My speculation on why these are so hard to get is that there were some rumors earlier this year that the iPhone 6 Plus was going to have a sapphire screen. And that's how they were going to differentiate the 6 Plus from the 6. This has a Gorilla Glass screen, right? And GT Advanced, the sapphire makers, in bankruptcy because they couldn't scale up the sapphire production. So what I think happened is earlier this year, when they were having the production issues, Apple had to scramble to find an alternative supplier for the 6 Plus to make glass screens, which is why these are in such short supply. So I don't think it was just they screwed up the demand. I think they knew that people wanted these. I think they wanted to make these sapphire, and when their sapphire supplier couldn't actually commit to making the screens at the scale they needed, they had to go find somebody else to make the screens. Now they're catching up, right? And I don't think they're saying this publicly, but I think that's exactly what happened. But this was the more important thing. If you think about the timing of the iPhone, they probably had to make a decision on whether to go with the sapphire screens or the glass screens probably about 6 months ago. And so that's what actually happened with this company GT Advanced, which is, if you look in Bloomberg, one of the interesting things is this is the CEO of GT Advanced, and this is March 2014. And what you can see is he started dumping all of his stock to the tune of selling $10 million worth of stock right before the bankruptcy filing of GT Advanced. Matter of fact, these greens represent restricted stock grants that he was given. The second he got a grant, he dumped it. Dumped, got a grant, dumped it. Got another grant, dumped it. Dumped it. He's been selling all of his stock. Matter of fact, the other person that has been selling all of his stock is the chief operating officer of GT Advance, which was, sorry, there's a previous screen. It's Tom Gutierrez, Don Squiller. Let's go back to Squiller. So HDS, you can get this going by holders, and you go to ownership, and then you can go to insiders, holder detail, and Dan Squiller is his name. He was the chief operating officer, and here is his shareholder transactions, little graph. So again, this is March 2014, sell, restricted stock grant, sell, 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 bankruptcy filing. So it's interesting that there's a rumor in the Wall Street Journal that these people might be prosecuted for insider transaction knowledge by the SEC. And to be honest with you, I hope so, because there's a lot of smoke here in terms of what's going on, because they filed apparently a registration saying that they were going to sell their stock in March. But I think it's an interesting timing coincidence about the time that Apple probably made a decision to not use their product, and now they're in bankruptcy. And by the way, what's also interesting about the insiders is while they were selling, all of their underlings were buying. They were the only two people in the company selling. Everybody else was actually buying stock during the period of time. But if you're making a deal with Apple, the CEO and COO are most likely to know when things are going to not go right. Because, by the way, the guy who's the COO was the guy who was in charge of the Apple relationship. So, just saying. Interesting use of Bloomberg to get some additional real-time context to what you're seeing happening on the news. So, just FYI. All right, so for purposes today, the other reason why I'm in Bloomberg is I want to go back to our assignment. So, for Coca-Cola or for any company, this is a step I've already completed for the assignment, but this is something you're going to have to do next week. So, I'm just giving you a sense of this, which is we're going to have to get financial data, specifically historical financial information about a company. In Bloomberg, if I go to KO, U.S. Equity, this is Coca-Cola. FA, Financial Analysis. And then these are a series of tabs with financial statement data for a company. I'm going to click on IS, which is the historical income statement data. Now, standardized is as it sounds. Basically, this is a standardized Bloomberg format for the income statement. If I click on as reported, it's also as it sounds. This is the way that Coca-Cola actually listed it in their 10K. Okay? So basically, Bloomberg puts both formats in. The way the company listed in their 10K, and then what happens is a Bloomberg person curates that data, puts it into a Bloomberg standardized format. That is the standardized income statement, balance sheet, and cash flow. That is going to be a very important format for us because what we're going to do is we're going to take this standardized format and we're going to use that in our model. That means that if I use a different company, pick, I don't know, Home Depot, then if I export Home Depot's data, then it's going to come into our model in this format. If I pick FedEx, then it's going to come into our model in this format. Okay? So basically, that's what we're going to do. We're going to use a standardized format for our data. So again, sorry, just by the way, be on the lookout out the window. We just had a tornado warning issued for the University of Maryland. For those of you on the video, it doesn't look that bad out there right now, but just in case anybody hears anything. All right, so output. We're going to output this to Excel, but before we do, so we have it in the proper format, we want to make sure we have it in the right settings. So you will need to adjust your settings in Bloomberg to these settings. So specifically, number of periods, we're going to make 6. Okay, so we're going to have 6 historical years worth of data. Bloomberg has more than that in its database, but we're going to have 6 years. In addition, annual data is our primary period, and we want to make sure that we use standardized. Filing status, most recent, standardized. In addition, for data, I want to make sure that all these 4 boxes under here are not checked. All right, so I don't want to include the estimates. I don't want to include the current last 12-month data. I don't want to have common size. I don't want to have percent college. I just want the historical financials. For display, this is also important. I want to display, excuse me, in what's called ascending order, which means the most current year is on the right and the most oldest year is on the left, as opposed to descending order. So I want the oldest to newest, ascending. And then I want it to be in commas. All right. And finally, under the Report Excel tab, I want the report to be a table, not a chart. And Excel, this is a newer feature for Bloomberg, export as value as opposed to export as formula. So that means when I dump out Excel, it's going to give me a bunch of numbers as opposed to a bunch of references, which when I leave the lab is going to cause me problems. Okay? So this is where we're going to set our, and we're going to include the reference items. By the way, that's the other thing. Make sure that's checked. When I update that, this will save, excuse me, this will save those settings individually in Bloomberg. And so now what I'm going to do is I'm going to output to Excel. So output Excel, the template, and then it's going to basically say in Excel, it'll probably give you a security warning, yes to the security warning, and then it'll give you this template. Right? And then file, save as, put it somewhere where you can find it. And I'm calling it KO for ticker symbol -IS for income statement. Okay, I'm going to be putting these into Canvas so you'll see the data file dumps. All right, so there's the income statement, and I'd already done this in the previous class, but nonetheless you can see that that is the file that I just downloaded. All right, so save that, yes. All right, I'm going to do the same thing for the balance sheet. So I'm going to come here to BS tab, standardized, output, Excel, current template. Every time you export, it's going to give you a security warning. You have to hit yes. If you don't, make sure it might not be hiding behind a previous screen. Again, because we did it with exporting values, notice how these are numbers. So again, File, Save As, and again, I'm going to call this the KO as an Excel workbook, the KO balance sheet. And finally, the cash flow statement. Cash flow, standardized, output, Excel, current template. Yes to the security warning. KOCF. Okay, I already got it down there, so I'm not going to worry about it. All right, so long story short, I've just exported those 3 statements. Now, why did I do that? Well, if I go back to, and I'll put them online into this folder. So the files are there just so you can have it as a reference. All right. So if I go back to Excel, then I have this file that I gave you. Now the file that we're going to use as the starting point for our valuation, generally the tabs go from left to right. Right? So the oldest tabs are on the left, or sorry, the more data tabs are on the left, and then the workflow will kind of work to the right. So the first 3 tabs of the valuation model are the income statement, balance sheet, and cash flow. So are we still okay? No tornado yet? Okay, just double checking. See people looking out the window. All right, so we have the income statement, we have the balance sheet, and we have the cash flow that we just exported from Bloomberg are the first 3 tabs in this model. All right, so here's the nice thing. I've already put them in. You don't have to put them in. But when we switch companies and you do any other company, then what you can do is you can open up in Excel the income statement of whatever company you just exported in that template, copy it, come here to the Coke income statement, paste, and basically just overwrite it. Okay, so that's what we're setting up. We're setting up the concept of a reusable model. So this is the income statement, this is the balance sheet, this is the statement of cash flow. Now, the next tab I want to talk about is the income and the balance tab. All right, that's what they actually infer, which income stands for the income statement and balance stands for the balance sheet. So we're going to recreate the income statement and balance sheet in the income and balance tab. Now I've already done that. Right? So this is the Bloomberg formatted standardized income statement. Now the reason I'm recreating it is that we're actually going to also put into this tab the forecast. Right? So the income and balance sheet tabs in the model are going to be the ones where we're actually going to have 11 years of forecasted data plus the 6 years of historical data in both of these tabs. Okay? So that's what we're about to do, is we're about to create that forecast. Right? So in order to do that and make this a reusable model, we're going to pull the data from the income statement or balance sheet tab and move it over to the income tab and the balance tab, and then create the forecast on top of that. Right? Sorry, we're all being distracted by the heavy rain outside. Does it still look safe? Okay. If it does look really unsafe, just move away from the windows and we'll go to the inside. I'm sorry? You can freak out some people on the recording, just all start yelling. Yes, let's just hope that this isn't one of those YouTube videos that people see later. Anyways. So back to this. Seriously, if there's anything safety concern, we'll move away from the windows. We can go inside. So back to this. The other reason why we're going to do the income statement and balance sheet tab the way that we're going to do it is that we're going to make sure that they foot. Right? And I say that because even though these are considered Bloomberg standardized templates, as much as Bloomberg standardizes, every now and then they'll throw in something else. So for example, a common one I've seen is other operating revenue. The vast majority of companies do not have other operating revenue. But every now and then a company will, and they'll throw that in their standardized template, and then your statements won't balance. So by recreating the statement, and then literally on this tab, starting with revenue, subtracting everything down, and getting the same net income, when it doesn't balance, then at least I could go fix it before it really screws up my model. Now, it's not going to do that for Coke, all right? I've already double checked that, and the vast majority of companies, you won't have this problem, but by kind of recreating it, it will alert us to when we do have this problem. All right, so that's why we've done that. So from here, I go to the TFI, and unlike on your midterm where you had to do this yourself, I've already mapped the TFI to the Bloomberg statements for you and converted the TFI. I've also converted the TII and the CFI, as well as the economic profits. Now you'll notice there are two economic profit tabs in the model, and that's intentional. One is called EPBOY for beginning of year. The other is called EPEOY for end of year. Right? The EOY, the end of year data, is going to be used to create the ROIC tree. Okay? So that's where the ROIC for the ROIC tree is coming from. So again, same thing, the model will automatically create the tree for you. I've already set that up for you using relative references. The BOY tab, is what we're going to use for our valuations. The DCF and the EP valuation. So as you watched on Monday's video, the DCF and the EP valuation only balance when we use BOY economic profit. So that's why we have a BOY tab. So we can actually have balancing valuations, even though we're going to use the EOY tab to do some of the data analytics. So that's why we have two tabs. But essentially, what we've created is a model with relative references that flows all the way through. Now, the final two tabs I'd like to talk about are the assumptions and the ratios tab. Good model hygiene involves minimizing the places in your model where you make changes, because this is a very complex spreadsheet with a lot of tabs and a lot of fields. So I want to minimize the changes that I can make to it so that when I reuse it, I don't have to go everywhere looking for my changes, and then I forget something, and then I can't understand why my model doesn't make sense because I have one change from a previous version that I forgot about. So two things. We're going to minimize the place we make changes to these two tabs, assumptions and ratios. Right? That's the only place we should be making data changes. The other thing is I'm going to use the concept of a color, and I'm choosing yellow to tell me that anything that's a yellow field, I can change. I can put a hard-coded change in. Anything that's not a yellow field, I should leave it alone because it's probably an imported number, or it's a calculated result, or it's a relative reference. And if I change something that's not in yellow, I'm likely to break the model. Right? Now, you can use any color you want. I'm just happening to using yellow, but that's the point of why some of these cells are yellow. All right? So assumptions are one of my tabs. Here's an example of 3 assumptions I'm starting with. The last reported year, because obviously the years are going to change over time. How much cash we're going to use as operating cash, the weighted average cost of capital. So these are generalized assumptions that we're going to start, and we're going to add to this list as we go along. The other tab, and this is probably the most important tab in the model, is called the ratios tab. These ratios, with the exception of the growth rate, are all a percentage of sales, percentage of revenue. Okay? Now, this goes back to the process for best practice for forecasting financial statements. What we're about to do, step 1, is we're going to forecast income statements and balance sheets for 11 years. Right? The first 10 years for the explicit defined forecast period, year 11 is going to be for the start of the continuing value period. We're just choosing a 10-year period arbitrarily, right, for the forecast. Now, let's go back. As it was talked about in the readings for today, it's very important to understand that we don't want to directly forecast statements in the future. It's too hard to do. So what we're going to do is, rather than forecast the statements, we're going to forecast the ratios. So basically the process is this. We start with historical ratios. That's what's on this tab, which comes from the income statement and the balance sheet. Historical income statements and balance sheets. We then forecast ratios, and the forecasted ratios create forecasted income statements and balance sheets. So we will create the income statements and balance sheets from the forecasted ratios. That's the process that we're about to start. So let's get started. We're going to start out with the income statement. Again, we want to make everything a relative reference rather than hard code in numbers to make a reusable model. So starting on the Ratios tab, for 2014, what I'm going to do is I'm going to say for cell H1 equals previous year plus 1. All right, that's how I'm going to represent 2014. I'm not going to type in the word 2014. So again, I'm on the Ratios tab. All right. Next, revenue growth rate. As a placeholder, I'm just going to use whatever last year's revenue growth rate was. So for H2 equals G2 equals the previous year's revenue growth rate. And I'm going to make this a yellow cell to tell myself that this is something I could change in the future. Okay, so that's one of the things that I'm going to forecast as the revenue growth rate. Now the next line item that I'm going to forecast is EBITDA equals previous year's EBITDA. Now, this is actually a change from what I've done in previous classes, right? Because one of the things that you'll notice when you get into the valuations is that the key number that the model is going to care about and the key number the professionals are going to care about is the EBITDA, right? Which means in order to forecast EBITDA, we would have to forecast cost of revenue and operating expenses, SG&A, separately to create an EBITDA. It's extra work to get to the same number that we're ultimately going to care about, and it won't affect the model. So I'm just going to skip a step that's really a step that just adds work that adds no value to your model. Now, don't get me wrong. If you're going to a real company, they're going to want to see a forecast for a gross margin. They're going to want to see the cost of goods sold and the SG&A broken out separately. But in terms of the actual valuation, it does not matter. What's going to matter is the EBITDA margin, which is the cash profit from the income statement. So we're just going to forecast that directly. So revenue, EBITDA margin, two of the critical drivers of the income statement. So that means that DA is depreciation amortization. We're also going to forecast that as a percentage of revenue. So I'm going to make that yellow. But that's going to solve for EBIT or operating income. So basically, we're going to forecast EBITDA rather than EBIT. So what I'm going to do is I'm going to take my EBITDA and I'm going to subtract my DA. But that's not going to be yellow because that's something I'm solving for. Okay? Next, tax rate. I have to forecast a representative tax rate for Coca-Cola. Here's what I'm going to assume. I'm going to use these tax rates over the last 6 years to guess what I think the tax rate is forward. Generally, they're in the low 20s with the exception of one number. So what I'm going to do is I'm going to use the average tax rate for the last 6 years, and I think that that seems like a reasonable tax rate for Coca-Cola going forward, 22.3%, but that might be something I change later. So again, I'm going to make that yellow. That's just my starting assumption. Now, no plat, because I've forecasted a tax rate, then I don't really have to forecast a no plat separately. I can solve for the no plat. No plat equals operating income times 1 minus the tax rate. Make that a percentage to 1 decimal place. Again, that's not yellow. That is something that I solved for. And finally, net non-operating losses and gains equals the previous year. And again, I will make that yellow. Okay. So again, what you'll notice are some things we're forecasting, some things we're solving for. Because we don't want to forecast two things that are related to each other, because otherwise we're going to have to make them foot. Right? And this is how we're making the income statement foot. So those are the income statement ratios that we're going to forecast. Now we're going to, was there a question?
How did you get that 18.4?
So the 18.4 is the operating income times 1 minus the tax rate. So H8 times 1 minus H9. Okay. All right, so now we're going to go to the income tab. And we're going to start creating the forecasted actual numbers that these ratios would infer. Now, in order for you to see this a little bit easier, I'm just going to hide a few of the columns. Not delete, Just hide. All right, just so it's easier to see. So across the top, you'll see where it says history. Eventually, you could format these. We're probably going to want to format these to make them a little bit nicer. But right now, I want to at least separate myself because I'm going to have basically 17 years worth of data on here in just a minute. I want to figure out what's historical versus what's forecast. So that's why I have the history on the left, and I'm going to add the word forecast and just differentiate myself that this is a forecast on the right. Okay. So again, equals previous year plus 1 for the relative reference, and now I'm ready to create my income statement forecast. The first number on there is revenue. Well, on the ratios tab, I have a revenue growth rate. So on the income tab, what I'm going to do is I'm going to say equals previous year times 1 plus, from the ratios tab, the 2014 revenue growth rate. Now I'm going to probably also want to format this column. So 45719.2. So that's the point. We're using it as a placeholder, whatever ratio previously was. But if Coke were to shrink another 2.4%, then they would shrink to $45,719.2 billion. Right? Now, don't do this yet. This will be next week. But the reason why we're going to set this up this way is what if Coke grew at 5%? Well, then I go over here to the income tab, and then the income statement is automatically adjusted. This is what we're kind of setting up in the model. So like I said, right now we're leaving the ratios as placeholders, but eventually we'll go back in, put in more realistic assumptions, and then everything will flow through. Okay, that's what we're setting up. As I said, don't do that now. The good news for the people in the video, all clear. The tornado warning is lifted. Okay, so let me undo this. Okay, so back to this. You want to have 45719.2. Okay, next, excuse me, the next ratio is EBITDA as a percentage of revenue. So what I'm going to do is I'm going to come back to my income tab for EBITDA equals 2014 revenue that I just forecasted. Multiply it by, on the ratios tab, EBITDA as a percentage of revenue, H6. Depreciation equals 2014 revenue times ratios 2014 depreciation as a percentage of revenue. Operating income, solve, equals EBITDA minus DA. Forecast the EBITDA, forecast the DA. That gets me my EBIT or operating income. $10,853.6. Next, we're going to have some miscellaneous items that we didn't forecast. And what I'm going to talk to you about are some simplifying assumptions that we're going to make that don't have a big impact on the valuation and will make our lives a little bit easier. All right, first, as was talked about in Monday's video, when we do enterprise DCF, we assume a target capital structure for the firm. So since we're going to leave the capital structure alone, we're not going to change the debt of the company. Since we're not going to change the debt of the company, we're not going to worry about the interest expense changing as well. So to keep it simple, equal the previous year's interest expense. The honest answer is forecasting the interest expense has no real impact on our valuation. All right? And you'll see that when we do the valuation next week. So we just want a placeholder in there for interest, so fine equals interest expense. If any of these assumptions you want to get more granular with and you want to forecast it more specifically than we're doing, have at it. There's not a reason to not do it. I'm just making your life easier on things that won't matter to the valuation. And this is an example of one that won't really matter. So equal the previous year. Foreign exchange losses and gains. Again, too difficult to predict. We're going to assume that companies will hedge appropriately, so therefore we're going to assume 0. All right? If you believe you want to forecast them, again, create your forecast, but now we're going to assume 0. All right? non-operating gains and losses equals 2014 revenue times ratios 2014 non-operating losses and gains. Pre-tax income. See over here on the left, we got some signs. So equals our operating income minus the interest expense, minus the FX, minus the non-operating losses and gains. That gets us a forecast for pre-tax income for Coca-Cola. Next, income tax expense. They're going to have to pay tax on that. Equals the pre-tax income times, from the ratios tab, 2014 tax rate. That would be the taxes they would have to pay, assuming that tax rate. Income before extraordinary items equals pre-tax income minus the taxes. That gets us an income before extraordinary items of 8690.7. Next, extraordinary loss, net of tax. The key word there is extraordinary. Extraordinary things shouldn't happen over and over and over again. Therefore, we're not going to forecast them. We're going to leave that at 0. Minority interest. These are payments to the minority shareholders. Again, since we're leaving a target capital structure, we're going to assume whatever minority dividends, we're going to keep distributing to the minority shareholders at the same rate, equals previous year. Net income. Solve. Equals income before extraordinary items minus the extraordinary loss, which is 0, minus the minority interest. That gets us our forecast for our net income. All right? Now, we've actually finished a forecast of the income statement for Coke. However, we're going to continue forecasting some additional items to get to a change in retained earnings, because it's the change in retained earnings that links the income statement with the balance sheet. Okay? So, in this case, cash dividends. Whatever cash preferred dividends the company was paying previously under a target capital structure, we're going to leave alone, equals the same dividends. Other adjustments to equity, 0. These are adjustments to equity that the accountants make, the AOCI type adjustments, when they're basically making changes that are being affected by accounting rules. So again, we're not going to be able to forecast those effectively. They often have no impact on the operating cash flows of the firm. Many of them have non-cash impacts whatsoever. So therefore, we're just going to leave them at 0. We're not going to worry about those other adjustments. All right? That gets us net income available to common shareholders equals net income minus the dividends minus the other adjustments. Abnormal gains and losses, 0. The key word there is abnormal, right? They're not operating. They don't happen again and again and again. It's interesting for Coke, they seem to happen again and again and again, but nonetheless, they shouldn't. So we're not going to continue to forecast things that shouldn't happen all of the time. If they're really happening all the time, they should be operating, and we should move them up to SG&A or cost of goods sold. They should be part of the EBITDA. So we're going to leave that at 0. Normalized income equals the net income plus the abnormal gain. And as I said, if you feel it's important to forecast an abnormal gain or another adjustment, you can always go back and do it and just adjust the statement. All right? Dividends paid equals previous year. Keep the dividends constant. So that gets us change retained earnings. Quirk of Bloomberg. The dividends are coming from the cash flow statement. On the cash flow statement, Bloomberg is reporting it as a negative number. So even though we subtract the dividends, we're going to add the negative number. So equals normalized income plus dividends paid. 3679.7. Yes.
With dividends, wouldn't it just go off of like the dividend payout ratio? Like what they're...
We could create a dividend payout ratio, but companies unfortunately don't do it that way. I'm just saying what they'll do is we'll pay $1 and then we'll add 2 cents to it, and then we'll add 4 cents to it. So they might target it, but they don't always change it every single quarter. They'll leave it at a number for a while, and then they'll up it as a step function. I mean, you could technically do it as dividend payout ratio, but I'm saying it won't matter to the valuation either way, the way we're doing it. Okay? But good point. Good question about that. As I said, if you believe you want to change the ratios for forecasting differently, you could always do that. All right, here's our last step. Now that we've forecasted our change in retained earnings, we've gotten the entire income statement forecasted, what we're going to do is we're going to go back to the Ratios tab, and we're going to take 2014's income statement, we're going to copy it, the ratios, and we're going to paste it out to column R, as in Robert, 11 years in the future to 2024. Then we're going to come back to the Income tab, and we're going to take column H, copy it, and again, paste it out to column R to 2024, so that we now have a forecast of Coca-Cola's income statement going through the year 2024. Finally, we want to go to the TII tab, which is all a relative reference to that income statement. Take the 2013 TII, copy it, go out to column R, paste it. I now have a forecast of TII, which balances going out to 2024. Now the years are relative references. So again, equals previous year plus 1. Copy and paste that out to 2024. So very quickly, a little over 15 minutes, what we have done is created an 11-year income statement forecast for Coca-Cola that is dynamic and adjustable via the ratios, which we can use for any company. We're about to do the same thing with the balance sheet. Questions about this? Anything we've done?
Did you do that for TII?
I did that for TII. Once we do the balance sheet, we'll do it for TFI. All right? Yes?
I was wondering if you could go over the
Go over which one? Well, pre-tax income for which year? 2014?
Yeah.
You mean starting from pre-tax income?
Or about 2015.
But I'm saying starting at row 13 and going down? Is that your question?
Yeah. Just like it was kind of quick there. I got it.
Yes. And as I said, the good news is it is recorded on video if you need to go back and look at a reference. But basically, from pre-tax video, the income tax is the ratios for the income taxes times the pre-tax income equals the taxes you pay. So the income before extraordinary items is the pre-tax income minus the tax. The extraordinary loss is basically saying that we don't assume that companies are going to report extraordinary losses in the future. The definition of extraordinary is they shouldn't recur. So we're going to assume those are zero. Minority interest we're assuming is the previous year. If you look over here on the left, you'll see some signs. And so that's the point. I'm using the format of the Bloomberg income statement. So when I get to the items in bold, those are things that I have to solve for. Right? So then I'm just kind of following away to get to net income. And so the same thing, dividends equal the previous year. Other adjustments we're going to assume are zero. Abnormal gains we're going to assume is zero. Dividends equal the previous year. Solve for the intervening variables using the signs on the left. The only quirky one is because the cash flow statement reports the dividend as a negative number, we're adding the negative dividend to get to the change in the retained earnings. Okay? All right, so back to the balance sheet. All right, we're going to start with the balance sheet ratios. And here's where we're going to differ from the textbook reading that you did for this week. Okay? So in the textbook, it talked about how the ratios need to be based on the income statement driver. So therefore, receivables should be based on sales. Inventory should be based on cost of goods sold. All right? However, we're going to tie every balance sheet item to revenue to make things easier and more straightforward. It also doesn't make that much of a difference to your forecast and has an added benefit. By tying everything to sales, then as revenue increases, the balance sheet increases. As revenue decreases, the balance sheet decreases. So what it really does is it allows us to grow or subtract at the current level of productivity of the firm. So in a way, we're forecasting productivity to stay the same. Now, because we have ratios, we can always change the ratios to sales to change the productivity assumptions. But at least if we leave the ratios tied to sales, it will grow or shrink the balance sheet. Which means when we get to CFI, it will grow or shrink gross investment. So as the company grows, the balance sheet grows. As the balance sheet grows, gross investment grows. And it will create the gross investment for us that measures that level of productivity. So essentially, by putting everything as a percentage of revenue, it actually helps us when we start doing the valuation modeling. So the other thing we're going to do is we're not going to forecast every balance sheet line item directly. It's not going to matter to our model. So I'm going to put the ones on here that matter more. These are the things that are primarily operating that we're going to forecast. So all of these are percentage of revenue. So in this case, equals the previous year. Make it yellow. Copy, paste all the way down and all the way over to 2024. One word to the wise. If you click on a range and you see this little anchor and you drag in Excel, you can actually drag copy. My recommendation is don't do that. Don't drag the cells to copy in Excel when you're working on this valuation model. Even though it's a nice little trick, it will actually screw you up. And the reason why is that Microsoft tries to be helpful, and sometimes it's too helpful. So one of the things it'll sometimes do when you click and drag is it'll say, aha, you're trying to create a series. It won't tell you this, but then it'll actually create a series out of your numbers, and it'll grow them in a series. And so you'll think you're copying and just dragging the same number, and Microsoft will turn that into a series. It doesn't happen all the time. It might happen 1 out of 20 times that you click and drag, but that 1 out of 20 times that it turned it into a series, your model doesn't bounce, you can't figure out why, you'll be really, really frustrated. So in order to avoid that from happening to you, I strongly recommend just copying and pasting. So Command-C, Command-V, or on a Mac, on a Mac, Command-C, Command-V, on a PC, Control-C, Control-V. All right, much easier to copy and paste than to drag, because dragging can cause problems. And it just means unintended behaviors by Microsoft. Yes?
Going along with that, is it all right that the tax rate is just a running average of the previous?
So that's a great point. I forgot to do that. Thank you for pointing that out. The other thing we wanted to do with the tax rate, so again, make sure we go back and do this. We had done an average in 2014 of the tax rate. In 2015, we don't want it to keep being a running average. So starting in 2015, we want to equal the 2014 tax rate. We just want to have one tax rate going forward. So copy the 2015 tax rate. Here's a good example. Copy, C, and then paste all the way through 2024. Good catch. Thank you for pointing that one out. I did skip over that one that I'd done in the previous class. Questions about that? All right, next, we're going to go back to the balance sheet, and we're going to actually start creating the balance sheet. So just like in the income statement, I'm going to hide a few of the historical years, just so it's easier to see on the screen. Don't delete. Don't want to wipe out the historical years. So again, I'm going to add the word forecast here, so I can distinguish between what's a forecast, what's historical, equals previous year plus 1. And we're going to start building out the balance sheet. Now the first line item is operating cash. That ratio is on the assumptions tab. It's 2%. Right? We can always change it later. So here's how we're going to do this. This is a percentage of revenue. So in the balance sheet for operating cash equals, from the income tab, 2014 revenue times from the assumptions tab, operating cash as a percentage of revenue. And again, I want to format this The accounting currency, 1 decimal place. Right. Now, 914.4. So here's the thing. On the ratios tab, I'm putting percentages that change year after year after year. So I can always change it year by year. On the assumptions tab, I have one number that never changes. So one of the things is when I copy and paste this number, I always want it to be an absolute reference. So on 2014, I want to change this to an absolute reference. $B, $3. Okay. So making assumptions, $B, $3, that tells Excel that it's an absolute reference, so no matter where I copy it, always refer to cell B3. Okay. Excess cash we're going to skip over, and we're now just going to go to the ratios. The first balance sheet ratio is accounts receivable. So again, I'll go back to my balance sheet tab, accounts and notes receivable equals ratios, accounts and notes receivable for 2014 times income 2014 revenue. Inventory equals, now go the other way. Income tab 2014 revenue times ratios 2014 inventory as a percentage of revenue. The next one is other current assets equals, so it doesn't really matter which way you go first, equals ratios other current assets as a percentage of revenue times income 2014 revenue. Long-term investments equals income 2014 revenue times ratios 2014 long-term investments. The next one is net fixed assets equals, from the ratios tab, the net fixed assets as a percentage of revenue times income 2014 revenue. The next one's other long-term assets equals other long-term assets for 2014 times income tab 2014 revenue. Right? Next one's accounts payable equals accounts payable as percentage of revenue times 2014 revenue. Next one's other short-term liabilities equals other short-term liabilities as a percentage of revenue times 2014 revenue. And the final one is other long-term liabilities. So equals from the income tab 2014 revenue times from the ratios tab 2014 other long-term liabilities as a percentage of revenue. So what you'll notice is sometimes I multiplied the revenue first and then the ratio. Sometimes the ratios and the revenue. Since I multiply, it doesn't matter which tab I go, but I have to essentially pair them up. The key is I want the 2014 revenue with the 2014 ratio for the balance sheet. So when I copy and paste, it'll stay consistent. All right. So those were the 10 ratios that we're going to forecast for the balance sheet directly. But we have to finish off the balance sheet. So what I'm going to do is I'm going to show you how to create a balance sheet that balances that does not have a circular reference. If you have a circular reference in your model, you have a flawed model. It is an incorrect model. You must not have a circular reference in your model. So I'm going to show you how to create the balance sheet without the circular reference. So we're going to finish off the liabilities and equity side of the balance sheet first. So come down here to equity, and I'll start with preferred equity. Target capital structure equals preferred equity doesn't change, equals previous year. Minority interest equals previous year. Share capital and additional paid-in capital equals previous year. The only thing that's going to change is the retained earnings. So on the income tab, we had created a change in the retained earnings for the company. So what I'm going to do in the balance tab is I'm going to say retained earnings for 2014 equals the 2013 retained earnings plus, from the income tab, the 2014 change in retained earnings, H25. That's going to be my retained earnings for next year. If I sum these up, these four items up, that gets me my total equity, 37,119.7. Next, I want to finish up the liabilities. Short-term borrowings equal the previous year. We're going to leave the debt alone. Current liabilities, sum the three. Long-term borrowings equal the previous year. Pension liabilities equal the previous year. Companies can't run pension deficits long-term. The government's not going to let you add to it. So we're going to start with the existing pension and leave it alone. We add up the three long-term liabilities. Equals current liabilities plus long-term liabilities, or the total liabilities. Total liabilities and equity equals the total liabilities plus the total equity, 93,304.4. Next, I want my balance sheet to balance. So here's how I'm going to do it. I'm going to force my balance sheet to balance. The way I'm going to force my balance sheet to balance is assets equals liabilities and equity. Right? So because I'm forcing my balance sheet to balance, my assets equaling my liabilities and equity, it means I've created the concept of what's going to be called a plug. I'm going to have to plug something in the asset to solve to get those total assets. Right? The plug for our model is going to be excess cash. So what we're going to do is we're going to solve for excess cash. That means all of the other line items in the balance sheet have to be finished, and then we solve for excess cash to get the balance sheet to balance. So what's left to solve for is, we've already gotten all these items, gross fixed assets. But here's the thing. Just like EBITDA, we've actually solved for net fixed assets. So we really don't need the gross if we have the net. We don't have to forecast them separately. Right? Now, in the model, we care about the net fixed assets when we do the CFI. So the gross doesn't really matter. So we're just going to skip the gross. We're not even going to forecast the gross. So we're going to leave that alone. Just leave it blank, and we're not going to forecast accumulated depreciation because all we're going to care about is net fixed assets. The other item is goodwill, equals the previous year. It's too difficult to forecast acquisitions, therefore we're not going to do it. And since goodwill is no longer amortized, it's only impaired, then we're just going to leave goodwill alone. And even if it's impaired, it doesn't affect taxes. It only reduces equity. So we're just going to leave it on the balance sheet there. All right? So equals whatever the goodwill the company has. Now we're ready to solve for excess cash. Excess cash equals total assets minus everything else. So total assets minus operating cash, minus accounts receivable, minus inventory, minus other current assets, minus long-term investments, minus net fixed assets, minus goodwill, minus other long-term assets. 23,995.1. Now I'm ready to sum up my current assets. Now I'm ready to sum up my long-term assets. Equals current plus long-term. And notice that these two balance. So I now have a balancing balance sheet. I don't have Excel telling me I have a circular reference. I'm almost done. Final step, take the 2014 balance sheet, copy it out to 2024, column R. I now have a forecast for the balance sheet that hopefully balances. So I'll make it a little bit wider. Through 2024. Which means I'm ready to go to my TFI and copy my TFI through 2024 because it's all relative reference to that balance sheet. So I copy 2013, I go out to column R, paste it. Now, because it's relative years, starting with H1 equals the previous year plus 1, so I have to copy and paste that years out. But I now have a forecasted TFI, which looks like it balances going out through 2024. Do the same thing for CFI. Take my 2013 CFI, copy it, go out to column R, paste it. I now have a CFI going out through 2024. EPBOY, copy that out 11 years. Equals previous year plus 1. And EPEOY. So it's very quickly, I now have 11 years of financial statements, 11 years of economic statements. The only tab that you really don't have to copy out 11 years is the change in equity tab. The reason why there's a change in equity tab is that in order to get the CFI to balance from Bloomberg, I had to go back out and figure out if the company made AOCI adjustments. So I basically went into the change in equity tab to solve for the other adjustments to equity historically. We're not making or forecasting adjustments to equity on the income statement or the balance sheet on a go-forward basis. So therefore, we don't really need to do this in the future. If you want to copy the tab out, all those other adjustments to equity will be 0. So you're welcome to do it, but it doesn't really mean anything in the future because we're not making those forecasts. Anyways, it's really just to get the historical CFIs to balance. That's why you had to do that. All right, so back to this. If you have reached this point and your CFI is 5370.7, I'll call this video. You're done with homework 4. So you're welcome to upload it. If you're not at this point, you have until Monday at 10 a.m. to get to this point. Because Monday at 10 a.m., we're going to pick up exactly right here, and we're going to get into the rest of the valuation. Okay? So this is an individual assignment. It's not a group assignment. You're not allowed to share Excel files. You're not allowed to upload somebody else's Excel file. You must create this yourself. Okay? But if you have, you're done with the homework for this week. If not, you have until Monday to do it. Now here's what's going to happen. On Monday, we're going to pick up from here. We're going to do the DCF and EP valuations. And on Wednesday, you're going to do this yourself for another company. Okay? Because we'll have the model built. You're going to put another company's data in here in the lab, and then you're going to actually do another valuation. So that's really what next week is, and we're going to get into much more heavy valuation work and actually using of all these models coming up. Because most of the content that we're covering this semester, we're pretty much done. Now it's going to get really, really applied. And we're going to be doing a lot of Excel work, a lot of lab work coming up. So Wednesdays will be graded, and again, we'll be just having assignments just about every class. So just kind of warning you that's coming up in the next few weeks. All right. Any other questions? All right. Otherwise, we are done, and I will see everybody on Monday. What do you want to look at?
He's looking at the excess cash.
Eventually it grows to almost 58 billion. So what's happening with the excess cash is that we're basically not paying out anything, so it's just all accumulating in cash. So that excess cash represents the cash that can be paid out as more dividends, stock buybacks, debt retirements, etc.